The price is lying and the spread is telling the truth. And that SY gold can be climbing at the same time. The dollar is quietly losing altitude right at the open right, when most people assume the hedge move should already be finished. Because this isn't a vibes rally, it's a plumbing rally. And the part that matters isn't the headline print you see on your watch list. It's the way the market is being forced to finance, hedge, and source the metal behind that print. Stay with me, because by the end, you're going to have a simple next 2 weeks checklist. The levels that matter, the confirmation signals that don't lie, and the one line in the sand that tells you the rotation is real, or that it's about to snap back the other way. Here's what the crowd sees. Gold up near record territory, flirting with that big, round 5,000 neighborhood that turns every desk, every fund, every central bank reserve manager into a headline. The dollar index not exploding, not collapsing, just leaking, not a crash, a drift. And if you live on headlines, that looks like the normal story. Risk, geopolitics, inflation, sure, gold up, dollar down, people are nervous, end of segment. But if that's all this is, then it shouldn't be happening like this. Not with this texture, not with this timing, not with this kind of stubborn bid that shows up even after pullbacks. And that's where the real pressure starts. Because in markets, the most important moves are the ones people feel late. They feel them after the curve changes, after the spreads change, after the hedges change, after the dealer books start acting different. And what we're rewatching right now is a hedge trade rotating at the open, capital moving from dollar as safety toward metal as collateral, and the mechanism is visible if you know where to look. So let's put the conflict on the table. There's a force trying to downplay this move, not a cartoon villain, not some movie conspiracy. It's incentives, it's positioning, it's risk management. It is the simple fact that a lot of professional portfolios are built on a quiet assumption. When things get weird, the dollar catches a bid, bonds catch a bid, and gold is a sidecar. If that relationship degrades, if gold starts acting like the primary hedge and the dollar starts acting like a funding currency with baggage, the portfolio math changes. The marketing changes, the comfort story changes, and nobody wants to be the one who says it out loud too early. But markets don't care about comfort stories. Markets care about constraints. And right now, constraints are tightening in a way that makes this rotation logical, not emotional. The next detail is what flips the whole setup. The hidden detail is this. The real signal isn't just gold up. The signal is in the structure, how near-dated pricing behaves versus later months, how spreads behave, how financing behaves, and how quickly the market is willing to pay for gold now versus gold later. When that changes, it tells you the market isn't simply speculating, it's prioritizing immediacy. And immediacy is where stress shows up first. Think about what a normal gold market looks like. Gold is special because it's both a commodity and a monetary asset. Most commodities live and die by storage and consumption. Gold mostly lives as inventory already above ground. That means gold futures are usually shaped by the cost of carry, financing rates, storage, insurance, and convenience yield. In calm conditions, later contracts are typically priced a little higher than spot because holding the asset has costs and money has a cost. That upward slope is contango. It's the market saying you can have it later for a touch more because time costs money. Now, when that slope flattens or inverts, when the front end gets relatively expensive, something changes. It's not just bullish. It's the market telling you that the convenience of immediate metal is rising relative to the cost of carry. Translation: people are willing to pay up to be certain. That's not a mood. That's a constraint. And that's why spreads matter more than slogans. This is where most retail gets tricked because spot charts are clean and spreads are messy. But messy is where the truth lives. Dealers and institutions don't live on spot. They live on basis. They live on financing. They live on the difference between what they can buy, borrow, hedge, and deliver. When that difference tightens, they adjust. And those adjustments become price. Now connect that to the title. Gold versus dollar. Hedge trade rotating at the open. The open is when hedges get recalibrated. Not philosophically, mechanically. This is when Asia hands off to Europe, Europe hands off to the US, liquidity shifts, and the market decides what it can actually clear at size. Then liquidity doesn't just make candles bigger, it makes hedging harder, it makes stops more violent, it makes dealers more conservative. And that S where you get these sudden, it moved before the news moments, because the move is the news. So let's talk about what just happened on the tape, but in a way that actually helps you. Gold has been trading in the high 4,000s, with futures prints clustering around the upper 4,700s to 4,800s recently, depending on contract and time of day. You've likely seen the market hovering near that psychologically magnetic $5,000 zone, where every round number becomes a battlefield. Meanwhile, the dollar index has been softer, spending time around the high 90s rather than pushing back toward the stronger regime levels people got used to. That combination is already enough to light up the metal crowd, but the key is not the number, it's the behavior around the number. Because if this one level breaks, the math changes. Here's the simplest way to think about it. When a market pushes into a new price neighborhood, three classes of participants get forced to act. One, trend and breakout systems. They don't care about narratives, they care about levels. They buy strength, they add on confirmation, they trail stops, they create follow-through. Two, options dealers and hedgers. When calls get bought and open interest stacks up near round numbers, dealers hedge in the underlying. That hedging can become reflexive. Buying begets buying, especially when the market is near a point where gamma exposure is concentrated. You don't need a perfect gamma squeeze for gamma dynamics to matter. You just need positioning that makes hedging flows one way for a stretch. And it often happens precisely when people think the move is overextended. That's not the part that matters. The part that matters is whether hedging pressure is still asymmetric. 3. The real money allocators and reserve managers. They don't chase 10-minute candles. They rotate across weeks and months. But they do respond to regime shifts. And when they sense that the default hedge is changing from currency and sovereign paper toward hard collateral, they done to wait for permission. They scale. Now, why would anyone rotate away from the dollar as a hedge? Not because the dollar stops being important. It's still the world's settlement language. But because being the settlement language comes with trade-offs. You inherit fiscal noise, political noise, and policy reflexes. The dollar can still rally and risk off. It can still spike in panics. But if markets start treating that rally as temporary, if the dollar becomes the thing you borrow and cover rather than the thing you hold and trust, then gold S-roll upgrades from hedge to alternative collateral. And that is a very different bid. You can see hints of this in the way the usual relationships have been misbehaving. The old rule of thumb says higher real yields should pressure gold because gold doesn't yield. If you can get paid in real terms to hold cash or bonds, why hold a shiny rock? That logic worked in clean regimes. But regimes don't last forever. When the bond market itself becomes a source of uncertainty, when the market questions fiscal trajectory, supply of issuance, and the credibility of future policy, then yield stops being the whole story. The opportunity cost argument weakens, because safety isn't just yield, it's the reliability of the promise behind the yield. And that's where the rotation starts. Now let's stack proof, because one argument is never enough in a market like this. If you want trust, you need layers. First layer, term structure and spreads. If you see the front end behaving unusually, flattening versus later months, tightening in a way that suggests the market is paying up for immediacy, that's a structural signal. It implies either elevated convenience yield, tighter availability, or hedging demand that's concentrated in the near term. In plain English, somebody wants exposure now, and they're willing to pay and carry terms to get it. That's real. Second layer, currency behavior. The dollar doesn't have to crash for this rotation to be meaningful. A slow leak is enough. A market can reprice hedges on a drift. In fact, drift is more dangerous for portfolios than crash because drift doesn't trigger emergency hedges early. Drift erodes. Drift changes correlations quietly. Drift forces people to rebalance late, and late rebalancing is where forced buying happens. Third layer, cross-currency gold. This is the underrated one, and it catches people off guard. If gold is only strong in dollars because the dollar is weak, then gold should look less impressive in other currencies. But when gold is strong across currencies, when it S at pressing highs, not just in USD terms, but also in Euro terms, Yen terms, and local terms, that's telling you the bid is global, not just a dollar mirror. That's the kind of signal reserve managers care about. That's the kind of signal that says the hedge is upgrading. Fourth layer, institutional flow behavior. You don't need perfect data in real time to understand the mechanism. ETF flows, ETP allocations, and large-scale purchases don't move like retail sentiment. They move like policy and portfolio decisions. They show up as persistent demand on dips, less sensitivity to intraday noise, and a market that refuses to give you the pullback everyone feels entitled to. When that shows up repeatedly, it suggests the bid is not fragile. Fifth layer, on-the-ground symptoms. Physical premiums, delivery timing, the types of bars moving, refining, and logistics capacity. These are not headlines, but they're how physical markets express tightness. Gold is not like stocks. You can't print more overnight. Refining takes time. Assay takes time. Logistics take time. If there is even a mild bottleneck, if the wrong form of gold is in the wrong place at the wrong time, then paper price and physical reality can diverge in subtle ways that show up first in spreads and delivery preferences. And that's where the signal lives. Now I can already hear the counterpoint forming. Gold is just momentum. It's stretched. Everyone's bullish. This is where it dumps. That's a reasonable fear. Gold absolutely can whip around violently, even if the thesis is correct. In fact, if the thesis is correct, volatility often increases. because the market uses volatility as a weapon. It's the oldest trick. Shake out the late longs, scare out the cautious holders, and reset positioning before the next leg. The market doesn't move to reward the most confident. It moves to punish the most emotionally reactive. And the next detail is what flips the whole setup. The key is to separate trend signal from noise. Trend signal is structural. Higher highs with constructive pullbacks, spreads behaving in a way that supports the move, the dollar failing to reclaim key levels with conviction, and dips getting bought in a way that feels almost disrespectful. Noise is intraday chaos, a scary wick, a headline spike, a fast flush that reverses by the close. Noise is designed to hijack your nervous system. Trend is designed to force institutions to rebalance. So what is the hedge trade rotates at the open actually describing? It's describing a weekly ritual. Funds come in with fresh risk. Dealers reset books. Corporate hedgers adjust. Macro desks look at what S coming on the calendar and decide what they can T afford to be naked into. And right now, the calendar is not neutral. You've got week opens where liquidity is thinner and gaps are more likely. You've got month-end behavior where portfolios rebalance not because they want to, but because their mandates force them to. You've got options windows where large open interest near round strikes can create hedging gravity. You've got policy and data catalysts that can reprice rates and the dollar quickly. And in precious metals, you'd have always got delivery cycles and funding conditions that can tighten when everyone leans the same way. The calendar is the catalyst, not because it predicts price, because it forces behavior. Now let's make the mechanism tangible. Imagine you're a dealer making markets in gold futures and options. When clients buy calls, you often hedge by buying futures. If the market rises, you have to buy more to stay hedged when gamma exposure is high. That creates a feedback loop. But here's the catch. Dealers don't hedge in a vacuum. They hedge with constraints, margin, liquidity, and inventory. If liquidity thins at the open and the tape starts to run, dealers become less willing to fade. They widen. They hedge faster. That accelerates the move, and that's why the open matters. It's the moment when small imbalances become big prints. Now add the dollar. If the dollar is softening while gold is firming, global buyers face a different equation. For a non-US buyer, a weaker dollar can make gold cheaper in local terms, until gold's own strength overwhelms it. That can actually pull forward demand. Meanwhile, U.S. investors who typically default to dollars as a hedge may find that the dollar isn't a T paying them for the risk anymore. Not because rates are zero, rates can be positive and the dollar can still drift. Because the marginal buyer is thinking about real purchasing power and policy risk, not just nominal carry. And when that shift happens, the hedge rotates. Here is the part most people miss. Gold doesn't need everyone to believe the story. It only needs a small number of big players to treat gold as the cleaner hedge than the dollar for a window of time. Because gold is a smaller market relative to global pools of capital than people intuitively grasp. Marginal flows matter. A few large rebalances can move the needle more than a million tweets. And that's why the mainstream often seems late on gold. It's not that they're stupid, it's that their framework assumes the old hierarchy. Dollar first, bond second, gold third. When the hierarchy flips, their narrative lags the mechanism. And the spread tells you before the anchor reads it. Now, we have to talk about risk, because this is where trust gets earned. There are clean ways this can fail fast. 1, the dollar rips, not drifts, rips. A sudden repricing of U.S. growth expectations, a hawkish policy surprise, or a global risk event that triggers a classic dash for cash can spike the dollar. In that scenario, gold can still hold up, but the path gets uglier. A strong dollar can force leveraged longs to reduce exposure and can compress the enthusiasm that fuels momentum. 2, liquidation cascades. If gold has become a crowded hedge, then a sharp move against it can trigger margin pressure. Margin doesn't care about your thesis. If volatility jumps and margin requirements rise, people sell what they can, not what they want. That can create a fast flush that looks like the top. Sometimes it is, sometimes it's a reset. The difference is in the recovery. 3, curve normalization. If the market's hidden stress signal eases, if spreads relax, if term structure returns to a clean, carry-driven shape, then the urgency premium can fade. Gold can still be bullish longer term and still correct hard when the structural urgency cools. So what invalidates the near-term rotation thesis? Not a red day, not a scary wick. Invalidation is structural. Gold fails to hold key breakout zones on a closing basis, and the dollar reclaims its own levels with momentum, while the spread curve signal stops confirming. That's when you stop treating pullbacks as tests and start treating them as trend breaks. That's the line, and that's where the real discipline starts. Now, let's talk psychology, because this is where most people lose even when they're right. If you're right on the big picture, the market's next job is to attack your timing. It will do it with 3 weapons. Weapon 1, the headline whip, a single policy comment, a single geopolitical line, a single sources say piece that moves the dollar for 30 minutes. Your brain will interpret that as a new regime. It isn't. It's noise unless it changes follow through. Weapon 2, the gap. Gold loves gaps when liquidity is thin. Gaps feel like proof when they go your way and betrayal when they don't. But gaps are just imbalances. Treat them like weather, not destiny. Weapon 3, the fake breakdown. The market will push price below an obvious level, trigger stops, create panic, and then reclaim it, because the goal is to transfer your position to someone with stronger hands. If you don't have a plan for this, you become the liquidity. And that's not a moral failing, it's just how markets function. So here's a simple shield. Decide in advance what is signal and what is noise. Signal is daily, weekly structure and confirmation from the hidden detail. Spreads, curve behavior, and dollar follow-through. Noise is intraday emotional chaos. If you can't separate them, you will always be buying tops and selling bottoms while believing you're managing risk. Because the market will train you to fear the very pullbacks that keep trends healthy. Now, the what comes next matters. Not in a fortune-telling way, in a roadmap way. Over the next week or two, you want to watch 4 things like a hawk. First, the key levels in gold around the recent breakout zone and the big psychological round number area. If gold pushes toward that round number and then pulls back, a controlled retest that holds and then grinds higher is constructive. If gold rejects violently and can't reclaim, that's a warning. Watch how it behaves after the first real shove. That shove is coming, because volatility always shows up near round numbers. Second, the dollar's behavior at the open and after U.S. data's policy moments. A dollar that sells off early and fails to rebound by the close is different from a dollar that dips and then rips back. The first supports the rotation, the second threatens it. The dollar doesn't need to crash to matter. It just needs to stop being trusted as the clean hedge. And you'll see that in failed rallies. Third, the curve and spread behavior. You don't need to be a professional spread trader. You just need to notice whether urgency is rising or easing. If the front end stays firm relative to later months, if the market keeps paying for immediacy, that supports the idea that this isn't just speculative froth. If that urgency fades while price stays high, it can still be bullish, but it becomes more vulnerable to a sharper pullback. Fourth, positioning behavior around options windows. If price magnetizes toward a strike zone and then accelerates through it, that can be reflexive hedging. If price keeps getting pinned and rejected, that can be dealers managing exposure. You're not trying to outsmart the options desk. You're trying to not get emotionally hijacked by the pinning and the sudden release. Now let's put the 2-scenario lens on it, because this is where credibility lives. Scenario 1 is the controlled pullback and retest. Gold pushes into the psychological zone, stalls, then pulls back in a way that feels boring and frustrating. People start calling it distribution. The dollar tries to bounce but can't sustain, spreads stay supportive, then gold resumes higher with less drama. This scenario is where the market tries to shake you out with impatience rather than fear. Scenario 2 is the continuation squeeze. Gold clears the zone with force, liquidity thins, and you get gaps up and down because the market is repricing in jumps, not steps. The dollar stays heavy. Dealers hedge, trend systems add, shorts cover, and the move looks too far for longer than anyone expects. This scenario is where the market tries to shake you out with volatility rather than boredom. It is also where gap risk is highest, both for longs and shorts, because the tape can move when we're not watching. Which scenario is more likely? The market will tell you, not by your feelings, by behavior. Controlled pullback means orderly candles, support holding, and the dollar failing to reclaim. Continuation squeeze means impulsive candles, fast reclaim after dips, and persistent urgency in the front end. And here's the subtle thing. Both scenarios can still include terrifying down days. That's not a contradiction. That's the market using volatility to test conviction. The question is not whether it sells off. The question is whether it sells off and stays off. Because if it sells off and immediately gets bought, that's not weakness. That's absorption. Now, before we end, I want to bring it back to the core truth. This isn't Tia's story about loving gold or hating the dollar. It's a story about hedging regimes. The dollar can still rally in a panic. Gold can still get hit in liquidation. But the rotation at the open, the quiet shift in what institutions reach for first, matters because it changes reflexes. And reflexes are what move markets when nobody has time to think. So if you want one metric to watch, one final revelation that keeps you grounded, it is this. Watch whether the market is paying for immediacy. Watch the structure. Watch the spreads and the curve behavior in the background of the headline price. Because when the price is lying, the spread tells the truth. And if the spread keeps saying gold now, then dips are not just dips. They are opportunities for the market to transfer inventory from weak hands to strong hands. And if you're the kind of investor who refuses to be emotionally farmed, who wants mechanism, not mythology, then you already know the real edge isn't predicting the next candle. It's understanding what forces participants to do next. That's the whole game. Dealers hedge, funds rebalance, central banks diversify, shorts cover, liquidity thins, and the tape prints the consequences. If you want to stay sharp with people who care about structure instead of slogans, keep your eyes on the checklist this week. Gold AES ability to hold the breakout zone on pullbacks, the dollar's inability or ability to reclaim key levels with conviction, and whether the market continues to reward immediacy through supportive curve behavior. No panic decisions, no hero trades, just clean observation and disciplined risk. Because the moment you stop chasing the headline and start reading the plumbing, the market gets a lot less mysterious and a lot harder to manipulate you with.